All right, guys, somebody sent me a video about a day or two ago, and it's titled Why Fed Rate Cuts Aren't Making Mortgages Any Cheaper. So I'm going to share this video in a minute and give some commentary on this. But I was at a Christmas party last night, and again, I had a gentleman, owned his own business, ask me a few questions. And one of the questions was along the lines of where's the market heading? And, you know, the hard part is this for me doing this so long is that I continue to see increasing home prices. As a matter of fact, I was writing an offer on a place in Newton about 2 weeks ago, and I think it was listed around $950, and they ended up getting offers that were like almost $200,000 over the list price. And this place it was a nice house. Don't get me wrong, it was a nice house, but it wasn't like some ultra-modern, completely blown-out renovation or something like that. It was on a nice street. But, what happens here is the prices of homes are exceeding what people could afford, right? So there's only not necessarily a small, depends on what part of the country you're in. Here in Eastern Massachusetts, there are a lot of jobs out there that could support increasing home prices, but there's a lot of jobs that can't. So what happens when the home prices just get so high that the job in the market that you're working can't afford a mortgage? Okay. I talked about this a lot in a previous video. We've talked about the American dream and, all of these things. And, being young, having a family and stuff like that. As I said before, back in the day, you could have like 2 or 3 kids. Husband went to work, wife stayed home with the kids, and maybe he worked at a factory, or maybe he did something along those lines. And, you had your car, you bought your own house, and you lived a relatively comfortable life. Nowadays, you really can't do that. You have to have, depending on the area you live, of course, but here in Eastern Massachusetts, you really have to have a pretty decent job in order to afford a home. I mean, it was just a year or two ago where, the average income for buying a home was over $200,000. And I understand there's a lot of jobs here that support that type of income, but there's also a great majority of jobs that don't. So I'm going to share this video and give you some commentary. I am going to be pausing the video probably in certain areas and giving you some of my opinion on it. So just bear with me. I'm not going to go through the whole thing and then start the commentating. So let's get right into it.
Getting a mortgage in the United States is expensive.
I think that we're seeing some strain in the system, but until mortgage rates come down and supply increases, we're not going to see prices come down.
The average rate on the 30-year fixed mortgage today is hovering around 7%. In 2021, rates were at all-time lows. Consider how that affects the financing.
That's exactly part of the problem. So the issue here, and I'm sure they'll get into this, is that people locked in rates at an extremely low time. They were like sub 3. Those same people are holding on to their homes. They're not selling. And even if they didn't buy a home, they refinanced during that time. So why is somebody going to sell their home at, let's say a 2.75 rate, get into a 6% rate and get a lesser product, right? Because the home that they're buying, even if it's a downgrade or something smaller, unless they move in a completely isolated part of the country where home prices are just not quite as high as here, why are they going to do that? Because ultimately, they're going to be spending more money for less home. And that's what part of the problem is.
For the typical American home, with 2021's rates, interest payments would cost around $157,000.
Look at this.
If it were financed in 2024, the cost jumps by a lot.
Right now, we have high prices and high mortgage rates, so it's a double whammy. Housing feels especially unaffordable.
Mortgage rates in the U.S. are determined by many factors, including the decisions made at the Federal Reserve.
We think that our policy was appropriately restrictive.
The place where the average citizen felt the collateral damage the most painfully, I think, has been in the housing market.
100%.
The Fed is now cutting interest rates, but that's not making it easier to buy a home.
I think the best case scenario is we're going to continue to see mortgage rates hover around 6.5% to 7%.
So why are mortgages so expensive, even as the Fed tries to ease economic conditions? The Federal Reserve's recent policies have had a dramatic effect on mortgage rates.
You had these record low mortgage rates during the pandemic that fueled all this buying, which pushed home prices up.
The Fed then raised interest rates to stop inflation.
We raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant.
Well, the Fed implemented what some people have called a rate shock. It has resulted in a market that really is just not functioning properly at the moment.
This sudden jump.
So here's what's going on, right? I read a study. I did a video on this a couple months ago too. Part of the issue is it's not only the people that are holding on to their homes that have low rates. It's also people around my age. I'm 39 years old. Okay. People that are around my age are okay with the rates where they're at. So that's the disparity between the two. People that own their homes or that refinance their homes and have these lower rates are waiting for rates to come down to that level. That's on one hand. On the other hand, the home buyers are okay where rates are currently at. So what happens there is when you have the difference between somebody waiting for lower rates and somebody that's actually okay with the way rates are at right now. Anytime something comes on the market, there is extreme demand because it's a supply and demand issue, right? So if people are my age, okay with the rates, something comes on the market, guess what? Every single person's going to flock to that listing and it's going to get priced up. It's just going to get priced up. And you have people that are holding on to these lower mortgages, which I don't blame them. I usually call them like the gatekeepers of real estate. So they want a similar rate, but they're not going to see a similar rate, at least not for a very long time. As a matter of fact, I'm 30, like I said, I'm 39. I don't know if we'll see sub-3 rates again in my lifetime. I don't know. You let me know what you guys think. I don't think that's going to happen.
And financing costs created a lock-in effect in housing.
The lock-in effect itself came from the Fed raising interest rates relatively rapidly in 2022. So if you look at the interest rates that mortgage holders have out there in the market, over half of borrowers actually have an interest rate below 3.75% on their home. Folks are holding on tight there. That means less homes coming onto the market as those folks hold on, which means less housing out there to buy.
This leaves home buyers with fewer options on the market and a high cost to finance any home that they find. As a result, 26% of the homes sold in the United States were paid in full with cash in 2024, an all-time.
Let me tell you something about this cash thing, okay? Now, somebody, I don't remember when, on a previous video said nobody's paying cash for homes or something, like some, whatever, right? No clue. This guy has no clue. So that 26%, do you know what it is here in Eastern Massachusetts? It's closer to 40%, which is absolutely insane because I've looked at charts in the past, let's say pre-COVID, and about, I think it may have been 13 or 14% of homes sold pre-COVID were being paid with cash. Now it's closer to like 40%, which is crazy. Now you might be thinking to yourself, well, how do so many people have that much cash, right? The fact is, a lot of people are using their investment accounts. This is how it goes, right? It's not like somebody has hundreds of thousands or millions of dollars in a bank account. Of course, that does happen too, here and there. But a lot of people are cashing out their certain equities or portions of their portfolio. And what they're doing, here's what they do. They will pay, I've had this happen to me personally on one of my listings. They will pay for the home in cash from their investments. And then what'll happen, sometimes just to get an offer accepted, right? It's not only because interest rates are high. A lot of people are paying cash because there's effectively no contingencies, especially if they waive their inspection contingency. There's no mortgage contingency. There's no appraisal contingency, unless they include an appraisal contingency, but 99% of the time they're not if they're paying cash. They're doing that just to get a home under contract because there's multiple people doing this. So then what'll happen is they pay for the home in cash and they're either doing one of two things. They're either waiting for rates to come down so that they could refinance their house at a lower rate, or they are just refinancing right off the bat or within the first year because they want to gain some of that cash back. But they use their cash so that they could at least get an offer accepted. Yes, what I'm telling you is true. Yes, you may not understand this if you live anywhere outside of Eastern Massachusetts, but that is the way it is, specifically for single-family homes. Condos, there's more inventory, so that's less likely to happen unless it's some totally unique property that you don't see come on the market that often in some building that doesn't have a lot of sales, whatever it may be. But 26% nationwide for cash, that's extremely high, guys.
Time high. The remaining 74% of home buyers relied on mortgage financing. Those new mortgage holders are, on average, paying over 35% of their income on housing.
If you think about a 30-year mortgage, you're going to your bank and you're entering into a financial obligation to make 360 payments and then the mortgage is paid off. It doesn't usually take 30 years for a mortgage to get paid off. In fact, the average effective mortgage maturity is only about 8 years.
That's how long folks typically hold them before they're either selling and moving to a new home or refinancing to reduce their interest rates.
Many Americans are waiting for interest rates to fall. The Federal Reserve started a rate-cutting cycle late in 2024. The Fed's main tool, the federal funds rate, determines how money flows between banks. Lower interest rates can make loans cheaper, but so far, this has only had a limited effect on mortgage rates.
The interest rates that they can set are much less effective than most people assume. Since when they announced the first rate cut, the Treasury rates have gone up, the mortgage interest rates have gone up. They're trying to persuade people to do things in the market, but the market has its own logic, its own intentions.
It's not likely that home prices come down, typically. It's a much better hope to find affordability from rates coming down, and that can certainly happen, but it is going to have to come as a result of weaker economic data, lower inflation, or significantly less government borrowing.
Mortgage rates are greatly influenced by the U.S. economy. Bankers keep track of that by observing the yield, or return on investment, from loaning the government money for 10 years.
Your Treasury investments are thought of as relatively risk-free. You're lending money to the federal government, you know they're good to pay you back.
Some investors think the Treasury yield could rise from here.
If folks start to feel like our spending is getting a little bit out of whack, and they start to question if the U.S. citizen can actually, meet this tax bill further on down the road, they may want higher compensation.
New mortgage rates change over time, roughly in line with the 10-year Treasury yield. But there's an additional fee baked into mortgage rates to account for the risk of taking on the investment. The amount of the additional fee is called the spread.
Most of that spread is accounted for via risk. When you look at mortgages, there are a couple of kinds of risk that are added there for that spread. One of them is credit risk. If I lend money to an existing mortgage holder to refinance their loan, or a potential home buyer to buy a new home, are they going to be able to pay me back over time?
That additional fee, baked into new mortgage rates on the market, has increased since the Fed started to tighten the economy. As a result, people who take on new mortgages are paying more than they otherwise would in normal economic conditions.
But it's not as if a mortgage lender is looking at a 10-year Treasury yield and simply deciding what mortgage rates are going to be based on that. In fact, there are an entirely different set of bonds called mortgage-backed securities. The demand for mortgage-backed securities can wax and wane, and it's the price of those mortgage-backed securities that directly dictates what a mortgage lender can charge.
Today's mortgage rates are also influenced by the Fed's response to past emergencies.
Global financial crisis was in large part driven by a significant housing correction. And so in order to try to stabilize the housing market, not only did the Fed commit itself to buy U.S. Treasury debt, they also committed to buy agency mortgage-backed securities.
And that had a distinct downward pressure effect on rates.
In this process, the Fed buys huge amounts of debt to alter demand in the bond market.
It shifts the supply-demand equation out there, effectively reduces the interest rate on mortgages that's being offered out there.
Mortgage rates fell through the decade as the strategy played out, which made financing a home cheaper. The economy eventually recovered. The Fed returned to this technique in the pandemic.
They were extra aggressive in 2021 with buying mortgage-backed securities, so the QE, and that was ill-advised in hindsight.
The Fed is now reducing the amount of mortgages that it holds. Experts call this process quantitative tightening.
Quantitative tightening is the exact opposite. They now have a portfolio on their books. They don't want that anymore, and they begin to slowly let that run off.
This is an experiment that's never been done before. I think that's one of the reasons the mortgage rates are still going in the wrong direction from the Federal Reserve standpoint. And that's a problem. That's a political problem as well as an economic problem.
Bankers believe the Fed could complete its current cycle of quantitative tightening in 2025.
When you look at the Fed's interaction in the mortgage market, I think
so. Basically, what they're talking about, just to give you some insight here. So they made some major changes, obviously, during COVID, based off of previous data, right? But then what it ended up happening is they basically needed to increase these rates and slow the market down to some extent, amongst other things. And they, in 2024, the Fed, or I'm sorry, was it 24? Yeah, it was 24 this year. They were a lot of people were anticipating lower rates heading into 2025. And as a matter of fact, I think it was either Q3 or the end of Q2 is when you started to see a little bit of rate cuts here or there. And the mortgages actually didn't go down that much. The day that I remember this, the day that they cut rates, mortgages actually went up a little bit, and then they started to trickle down. A few days later. And a couple of people, came back into the market. They bought a home, so on and so forth. But the problem is I believe, were promising more rate cuts heading into 2025. And I think a lot of people out there, realtors, mortgage lenders included, beside the public, they were anticipating many more cuts. But as of, it was either, I believe it was yesterday or the day before yesterday, they made a slight cut, which was 0.25%. And they said heading into 2025, at least right now, this could be subject to change, that they only have 2 more rate cuts planned. So if you're waiting for 2025 to potentially buy a home, or if you're waiting for 2025 and rates to decrease substantially, I don't think that may happen in 2025, at least not in the first few quarters of 2025. I think this is a, future prediction, could be completely wrong. I think that around the same time next year, I think they'll have more of a plan heading into 2026, depending on how things play out in regards to inflation, our economy, so on and so forth in 2025. Of course, we have the changing of hands here with the presidential election. That has a lot of influence in this too. But let's continue with this.
Short synopsis, I think they would prefer not to be there. They don't want to disrupt the market too quickly, but they do want to gradually exit that market.
The Fed's best estimate suggests that mortgage rates could trend above 5.5% through 2025. Other forecasts are higher.
I wouldn't be surprised if you see mortgage rate maybe settle down in the low 7% range, say 7 to 7.5%. So unfortunately for those homeowners who are looking for a bit of a reprieve on the mortgage rate side, that may not come to fruition.
The decision to buy or keep renting is heavily influenced by prevailing mortgage rates. Renters are currently paying $1,000 a month less compared to owners with a mortgage. That said, the 30-year fixed-rate mortgage is a unique benefit for Americans. Many other countries use adjustable-rate mortgages that respond more quickly to central bank decisions, for better or for worse.
It makes for a lower payment than you might otherwise find, and it makes for more certainty. Some would say that we end up paying more interest over time as a result, but others would say it's a luxury that helps us afford more home than we otherwise might want to buy. You don't ever want to assume that rates are going to do something in the future just because people are saying they will, or because you feel like they will. Rates are where they are today, and there's really no guarantee that they'll be there tomorrow or that they won't be higher.
In an ideal environment, the Fed's not doing anything. But when the Fed is active, they absolutely do have an impact on what you're going to pay to buy a new home.
So ultimately, just to sum this up and give you some of my insights, some feedback here, I've said this before, I'll say it again. So when it comes to buying a home, if you're waiting for rates to come down, if you're waiting for home prices to come down, whatever it may be, you're really playing with fire, right? You're playing with fire. Most people that we have consultations with, we try to figure out what their timeline is like, not only for buying a home, but also potentially selling a home. How long are they going to be in said home? And we do a lot of risk management in the terms and the regards of, is this going to be a good investment if we are going to sell in the short term? Is this going to be a good investment if we sell in the longer term? And all of that boils down to what the rates are when they buy, what the home prices are, where they're at, and all of that put into, you put all this together, and then that's where you're able to give some, at least, educated, data-backed advice on what they should or shouldn't do. And what I mean by that is, do they continue to rent, right? Especially if it's going to be a shorter term purchase. If they're going to be a longer term purchase, it may be in their best interest, meaning they're going to stay in the house for a certain amount of time. And as you said, most people sell around 8 years, right? They do something after 8 years, especially on their first house. The statistics change based on if it's your second house or third house, whatever it may be. But for the most part, most people sell their first house within the first 8 years, give or take. So the best advice I could give you is, if it makes financial sense to you to buy a house right now, then you should buy the house now. Okay, I'm not telling you to buy a house. I'm just letting you know that if you could financially afford a house, that you should do that. And you shouldn't wait for something to happen to influence your opinion on whether or not you're going to buy. And I'll give you one more bit of insight. So I talk about this a lot, and it's called the cost of waiting. So what the cost of waiting is basically home prices continue to rise. All right. If there's not a dramatic cut in rates, chances are the same home that you're looking at today is going to be substantially more in the future. And you would have to have, of course, I don't have the calculator in front of me, right? But you would have to have if homes are appreciating at 5, 7, or 8% year over year, and the home prices are already $800,000. I mean, you're talking between $50,000 to $75,000 more next year versus today. How much of a rate cut would you have to get in order to at least be whole or even to some point? So that's what the cost of waiting is. You're spending more money for the same house in the hopes that the rates will be down. But what will the rates have to be in order for you to effectively pay the same amount you would have had to pay at a $75,000 cheaper house today with higher rates versus potentially lower rates in the future, but a $75,000 more mortgage? A good way to look at this is, for every $10,000 in a mortgage, depending on where the rates are at, let's say they're 7%, for every 10 grand, it's basically around the lines of being about $70 per month. So you figure $100,000 mortgage is going to, at 7%, is roughly going to be around $700. That's just your mortgage. That's not your real estate taxes and insurance. And one thing that they didn't talk about, they talked about the natural disasters and stuff. The other thing too is insurances have skyrocketed. Homeowners insurance, that is, because of all the natural disasters. Obviously the economy and inflation could be affecting this to some capacity, but homeowners insurance is astronomical. And where it gets really out of proportion is if you're in a condo complex and you have your master insurance policy. Those have gone up like crazy. And the only reason I know that is because when I'm writing an offer or listing a condo and I'm looking at their budget documents and I see what the previous years that they were spending for their insurance versus now, it's just unbelievable. So anyway, guys, you buy a home when you're ready. Don't wait for rates. Don't wait for prices to come down. You're really playing with fire doing those things. Do it when it makes financial sense for you and your family, and then build out a game plan if it's going to be a shorter term purchase, a longer term purchase, whatever it may be. That's my advice. Great video, guys. I should have more later today. Bye-bye.